Hi, good evening, ladies and gentlemen. Once again, thank you for taking your time to join us here today. I'm Ziyang, portfolio manager for your Max portfolio. And I think it's a great time for us to update you guys again on how the markets and how the portfolios have been performing so far in the third quarter, especially given how treacherous market has been over the past quarter. So tonight, on the behalf of my team, I'll share more about the performance of MAC portfolios in third quarter, as well as some of our views for what is to come for the rest of the year ahead. So without much further ado, I'll start with my presentation today. So today's presentation, as usual, will be split into 5 parts. First, I'll provide a brief recap of the market performance and the main macro drivers in the third quarter. Next, I'll share with you guys more on the performance of our portfolios across the quarter. And third, I'll elaborate on the latest changes that we have made to the portfolios. Especially, you guys would have received the notification of the rebalancing for almost about 2 weeks ago. And we'll explain our rationale for doing so. And next, I'll also talk about what we see in the market ahead. And what are the opportunities that have arisen as a result of the kind of sell-off recently. And last but not least, I'm going to open the floor for Q&A, and I'll try to address all your questions that you guys may have about a macro market or the MAX portfolio in general. So to start, third quarter was when markets started to slow steam, partially because of inflation worries, as well as the Delta variant that has been popping up across the rest of the world. We are seeing that within in Singapore as well, when our daily case number has shot up to about 5K yesterday. Not only that, because of the Delta variant, what we saw is that global growth has been downgraded, especially the bigger economies like US and China. And then, of course, last but not least, within the quarter, we also see that huge debt crisis coming out from Evergrande within China. So a lot of the initial optimism for a post-pandemic global reopening was kind of marked by the surge of the more infectious Delta variant. And of course, I think the growth downgrade within the US itself is also partially driven by the Federal Reserve. The Federal Reserve actually downgraded for the full year 2021 from 7% down to 5.9%. So a total of 1.1% downgrade in terms of growth. And they also have announced that they are looking to taper their asset purchases by the end of the year. And if you look in terms of their rate projection, just by the mid-year, by the last review that we have shared, they have actually brought forward a lot of their rate hike projection, and that kind of builds on to kind of a fear that interest rates as well as will pick up, and that will affect equity market. So within China itself, we saw the regulatory overhang in China tech to continue, and the kind of debt crisis among real estate developer, particularly the Evergrande. But not only that, ever since then, that actually created an expose on the whole entire sector itself. But not only that, we also saw the kind of power outage, the kind of drag of the energy rationing on its production activities within China itself. And Europe, so the inflation thing is not just within the US itself. It's in fact sort of a quite global phenomenon. We saw that within Europe, we saw that within Brazil, Latin America, where because of the supply chain constraint, because of the COVID situation, disruptions, and rising energy prices, inflation has picked up within Europe itself. And Europe kind of also suffered from the spillover effect from China's weakness. Given that China imports a lot of its capital goods as well as luxury goods from Europe itself, so a slowdown within China has extended towards Europe as well. So as a result, if you look in terms of performance for the third quarter, MSCI AC World, if you can see from this column, it actually closed flat. And if you look into each of the different components, actually you see that majority of the different, especially within Asia and EM, there was a huge sell-off led by China. MSCI China is of course the one of the biggest loser of the third quarter. It's down 17.3%. But not only that, it has that kind of weakness within China has actually extended towards the Latin America region, given the fact that a huge part of it, because of the commodities as well as the iron ore production that Latin America runs, and then because of the slowdown in production due to not just the hard landing situation within China itself, but also, of course, that kind of energy shortage that has affected production activities has really affected the Latin America iron ore exports. And we saw that coming down quite badly for Brazil. But not only that, not only growth is slowing down, inflation is also picking up within Brazil itself. So that for the much of for most of next few slides, I'm going to elaborate a little bit more on the market movements. So within equity, if you look at it as a whole, developed market actually outperformed emerging market, and performance within the emerging markets were really mixed. So your EMEA, your emerging Europe, Middle East, as well as Africa, a huge part of it is actually Russian equities. Actually outperformed because of the rising energy prices, the rising Brent oil prices, natural oil prices, has actually drove Russian equities quite significantly. Overall, developed market continues to outperform the emerging market counterparts, given that the higher vaccination rate as well as the reopening momentum that was across US and Europe over the third quarter. Asian equities were really impacted by the sell-off within China, which is down 17.3%. Asia itself is down 8.4%. But not only that, you see within Hong Kong and South Korea, both of them, this equity market is actually down about double digit as well. The weakness actually spilled over to Latin America, as I mentioned just now, about 12.3%. So within the fixed income market, things were quite flat actually. Treasury yields kind of traded flat for third quarter because markets were kind of divided on inflation and growth. So at the start of the year, I think the first half particularly, investors were kind of cheering that the rising vaccination rate could actually extend to a global reopening. But at the same time, we saw the surge of the more infectious Delta variant, and the vaccine, even though vaccination rates have been picking up, it seems to be a little bit less effective against this variant as well. So what we saw is that the surge of Delta case variant, and that kind of hampered the kind of reopening schedule for a lot of the global economies. And markets were kind of divided between that. On one hand, we saw rising inflation, and by right, bond yields should pick up to compensate for that rising inflation. But yet at the same time, we saw growth kind of being downgraded because of the COVID situation. Before, of course, by in end of September, we saw that Fed has announced its tapering in response to that kind of inflationary overshoot, and we saw US Treasury yields starting to pick up slightly, but overall, market is still kind of divided between that inflation as well as growth expectations. So for fixed income market, they barely moved for third quarter. It's down about 0.9%, which brings year-to-date performance about 4.1%. Of course, a huge part of the story is really the Evergrande, as well as China real estate developer and the whole Asian high yield bond segment, where it's down about 6.6%. In fact, I think it is at its worst, it's almost down double digit for this particular. Although after things started to stabilize a little bit, when I think there was a bit of certainty given about especially I think across the quarter, we also saw Huarong crisis at the start of it being resolved before it moved on to the Evergrande situation. And the Evergrande situation at this point of time, it's actually started to stabilize already. They announced that they will they managed to pay for the latest debt, and I think they are still in talks to be able to try to restructure their debt so that they can afford to pay out their loans. So global bonds on aggregate, of course, the bottom performer is Asian high yield at negative 6.6%. So for much of third quarter, especially in September, investors became quite concerned for Evergrande's ability to service its mounting debt, given the fact that it has quite a bit. It was very highly leveraged, and it's already the second biggest property developer within China itself. So the potential collapse within of Evergrande actually sparked concern of a contagion effect, possibly escalating sort of a Lehman type collapse within the China financial sector, affecting the other downstream sectors like banks and beyond. And of course, from there, potentially things could escalate. It could escalate even further. But fortunately, that didn't happen because after all, this weakness is kind of triggered because of the trade red line situation regulation that was implemented by the Chinese regulator. So in a way, you can say that this situation is kind of self-manufactured in a way, and I think therefore we kind of in the past few webinars we actually also share that we didn't see that it's actually that big of an issue, but I'll talk a little bit more later about this. So in terms of performance for third quarter, it was a sort of a roller coaster ride because of the inflation worries, Delta variant, and growth downgrade. Our portfolios actually kind of seesawed across the months. For third quarter, the conservative portfolio is down about 1.4%, all the way to down 22.1% for the aggressive portfolio, bringing our year-to-date performance of the conservative portfolio of 0.1% for the growth type and 7.6%, which also means that we are now, other than the conservative portfolio, for moderately conservative all the way to aggressive, we are slightly behind our benchmark in terms of returns. And this trend is quite similar to that of the income portfolios, where we saw returns of negative 1.5% for the conservative for third quarter, all the way to 2% for moderately aggressive and aggressive for the third quarter. And that brings our year to date to a negative 0.6% for conservative, to 3.8% for balance, and 7.1% for aggressive. So same as the growth portfolios, the income portfolios, only the conservative portfolio outperform its benchmark, while moderately conservative to aggressive is behind their benchmark on a year-to-date basis. So this is how it looks like in terms of snapshot on a month-on-month basis for the growth portfolios. You can see that while things were quite smooth sailing from Jan to from the start of the year to mid of the year, where we saw positive month-on-month gains for our portfolios every month. Things start to be a little bit seesawing from July. July, we recorded a little bit of a decline, and before kind of recovering in August. And I think September, because of the double whammy because of the tech crackdown, the prolonged tech crackdown within China equities, as well as the debt crisis within Asian high yield. And these two segments are kind of our overweights. And so therefore, I would say, the worst has happened for China itself as well as Asia. And that is also why the portfolios have underperformed, has performed a little bit badly during the month of September. But overall, I would say, given that the kind of double negative that has happened, overall on a year-to-date basis, things still look quite okay in our opinion. And this is actually the same for income portfolios, where we saw one of the biggest, of course, the biggest drawdown in September, between 1.5% to 3% for the month of September. But overall, so out of the 9 months, we only recorded two down months. So as a whole, on a year-to-date basis, I would say that this year it's still a pretty good year for investing. And looking ahead, we still do see opportunities arising within the market itself, which I'll share a little bit more at the end in the Q4 outlook. So in terms of the different funds performance, you can see that our developed market funds fund choice for US, your Lake Mason Clearbridge US Large Cap Growth, actually did kind of in line with S&P 500. Although on a year-to-date basis, it's slightly down because of that kind of yield pick up within the US Treasury yields. And I think because of the long duration asset nature of this fund is a little bit affected because of that. But overall, I would say that things are still pretty okay we are still quite comfortable with having this fund within our portfolios. And on the third quarter, for the more growth-oriented ones within Europe itself is doing actually quite okay. I think the standout performer here is the JPM Japan Equities funds. Is up 7.2% versus Nikkei 225 of 3.6%. Of course, on a year-to-date basis, it is quite similar to benchmark. But yeah, this is something that is quite good for us because we actually recently looked to increase our weightage towards Japan equities. And of course, within MSCI, within the digital economy, our OGIC ETF, our standout performer, which has performed for us quite well in 2020, hasn't been performing that great this year because of its higher weightage towards China equities, China tech players, and that kind of weighed down on its performance. But overall, the kind of exposure towards China tech is what we are looking for within the ETF, and therefore we are comfortable with holding this within the portfolio for heading into the rest of the year. So within EM funds, things were pretty mixed. Of course, Asian funds kind of paled in comparison to that of the Latin America as well as for the EMEA funds. But overall, you can see that majority of the fund choice that we have picked outperform our benchmarks, or in a way, they recorded a smaller loss than the benchmark in the third quarter. So MSCI Asia ex Japan is down 8.4%. And the standout performer is really, your First State, Diva, as well as your Fidelity Asia Pacific. Given it's a more value-oriented kind of stocks, they managed to avoid the kind of sell-off, more related to your tech players. And therefore, on a year-to-date basis, they actually outperform the benchmark at 4.5 and 8.3%. Of Latin America, of course, third quarter was really bad for it. It's the fund that we have actually switched into in start of July is actually down about 13.6%. And on the year-to-date basis, that brings it to about 4.4% a decline within the MSCI Latin America fund. And this is because of the kind of picked up in inflation within Latin America itself, in Brazil, and as well as the slowdown within China has really implicated this segment, which in our latest changes, we actually reduce our exposure towards Latin America, even though we are still quite optimistic in terms of valuations. It's actually still quite attractive, and it has Latin America traditionally has a very close relationship with global growth. So when global growth were to pick up, Latin America funds as well as EMEA funds, they usually, because of how strongly connected they are to the growth outlook situation as well as the commodity trades, they tend to pick up quite strongly. So that's not something that we are overly concerned about within Latin America at this point of time, because EMEA has been a really standout performer year to date. It's up. This Fidelity EMEA fund is up on a year-to-date basis by 30% versus the benchmark of 21%. And this is mainly driven because of the energy prices that have picked up quite significantly within your crude oil as well as natural gas. And one major part that was one major equity segment that contributed much of the performance is within Russia itself. And of course, our UBS Greater China Fund, is quite in line with that of the benchmark on a year-to-date basis as well as third quarter 2021, although it managed to outperform the benchmark slightly. So in terms of fixed income funds, Asian high yields were the one that really suffered a major setback surrounding that kind of property developer. Our East Spring Asian high yield bonds is within our portfolio, which we get exposure to, is down 9.1% in third quarter 2021. They had not just, they have a bit of exposure to Evergrande as well as previously Huarong. But as you know, because of the situation within Evergrande, it actually affected the whole entire real estate sector. And I think, in fact, if you look at all the funds surrounding Asian high yield, majority of them actually recorded quite bad losses in third quarter of 2021. But in terms of valuation at this point of time, things are actually really quite attractive, given that within fixed income market, yields are near zero, really, really low at this point of time. So Asian high yield, yes, they are a little bit risky at this point of time. But in terms of the kind of valuations, the kind of yields that it offered, is a lot more attractive than the rest of the bulk. And I think in terms of the negative that is being priced into the Asian high yield market at this point of time, we think that most of it is already being priced in already. So that's something that I'll spend a bit more time to talk about later. So our tactical ideas, which is the US semiconductor via the SMH ETF, and our global financials, which is BlackRock World Financials, actually did quite well. Didn't do as well versus the first half of 2021, but overall, they are able, at least for the global financials, is up about 1.1%. And semiconductors, even though things were a little bit affected because of the situation with slowdown in growth, they didn't react as badly as it is. So within third quarter, things were actually still quite okay, and we are actually quite comfortable with holding exposure to semiconductors as well as global financials. And this is important to remember that when we get exposure to these tactical ideas, we are really looking at it at least for 1 to 2 years kind of a time horizon. And at this point of time, we think because of the chip crisis, the kind of chip shortage within the industry, as well as that the world is moving into an increasingly digitalized one, demand for semiconductors is going to be something that will be a key driver for this segment, at least for the next 1 to 2 years. And it's something that we are looking to capitalize on. For global financials, things were quite good because that kind of 2020, when there was a lot of write-off, and there was a lot of margin provision, loan loss provision was kind of taken away from it. And as the global economy starts to slowly open up, although under the COVID situation, it's still quite slow, but as the global economy starts to open up, there's going to be a lot more loan activities, higher rising interest rate environment is going to benefit their global financials. And in the latest rebalancing, we actually added China and Hong Kong banks, something that I'll talk about a bit more later. It's down about 4% in third quarter because of the Evergrande situation. In fact, right now we see that valuations are really compelling enough for us to start adding. I think it is, in a way, things are a bit of a toss for China banks at this point of time, but valuations kind of is appealing enough to pad away or buttress against all this negative news. So that is also our rationale for adding it into the portfolio at this point of time. So previously, prior to October, we only had 2 tactical ideas within the tactical segment, within supplementary segment for the portfolio from Jan to September. but now we have three, so semiconductor, global financials, and China and Hong Kong banks. So this was the latest rebalancing. Before the last one was in July, when we kind of upgraded global bonds, downgraded the EM bonds to negative 2.5% to neutral, and we reduced Asian high yield exposure a little bit. So we kind of avoided a bit of the sell-off that was in September. So that was kind of a little bit timely for us. And then what we did was we actually reduced Asian exposure. So we kind of avoided a bit of the sell-off as well, and we increased exposure towards the US, although we still maintain the kind of underweight and overweight position. So within the fund, we also made a couple of fund switch for July. In the latest rebalancing that I've done in 2 weeks ago, these are the changes that I've made. So what I did was I reduced allocation to Latin America by 2.5%. The thing is that while we are still quite optimistic about that segment, given that its proximity or its correlation to global growth, and the kind of as things start to pick up again, we are going to demand a lot more iron ore, a lot more commodities. These are the products that Latin America regions export out. They should benefit for them, but at this point of time, things are slightly uncertain heading into the rest of the year. So therefore, we look to reduce our exposure slightly and to increase our allocation to Japan, where we see that things are starting to stabilize. So there's sort of a switch in situation between Japan and Latin America, and therefore, our portfolio wants to reflect the change of the positive and negative development in these two regions. For the supplementary allocation, we added AMC Hong Kong Bank ETF 3143 into the portfolio, and we redistribute the weight within supplementary portfolio such that it's evenly distributed between semicon, global financials, and China Hong Kong banks. This also means that we reduce a bit of risk to the semiconductor sector, as well as the global financial sector, and into the China and Hong Kong banks, where valuations are really quite compelling at this point of time. So over the next few slides, I'm going to talk about my rationale for doing so. So what we did was we upgraded Japan to neutral from an underweight position. At the start of the year, Japan was kind of relatively slow in terms of its vaccination rollout, which has led to its underperformance for the main bulk of the first half of the year. But after after the Olympics, the vaccine, especially I think since the Olympics, it was brought up to the authorities' attention that its vaccination rate has been really very low, and they have been doing a lot to secure vaccine supply and to increase or to vaccinate its population. And since then, its population has actually increasingly been fully vaccinated. And I think overall, Japan market is typically one of the most sensitive to global growth. About 40% of its revenue is derived from overseas market instead of its domestic market. And it's therefore still very well placed to benefit from the ongoing post-pandemic recovery, although the recovery has been slower than expected. But looking ahead into the second half of the year, into the rest of the year, or even the year beyond 2022, we think that Japan will be able to benefit from the kind of global growth recovery. Sales and earnings have been picking up and has been surprising that to the upside over the last few quarters. And in fact, right now, when you look at valuations of Japan equities, it's a lot lower than its developed market peers, both US and Europe. And in terms of historical sense, it's actually quite it is at its fair value at this point of time. So we think that things are going quite well for Japan at this point of time. Valuations are reasonable, so it's time for us to increase to move it from an underweight position to a neutral position. So we added a 2.5 weightage to Japan allocation, upgrading it to neutral. So this is the chart on the left shows its PE valuations on a historical sense. So since for the past 10 years, it has kind of hovered around on average around 17 to 18 times PE. And right now it's trading at its fair PE. So things are actually quite reasonable, given that valuations of global equities are near the top of their range at this point of time. So opportunities like these that don't come by a lot. So we look to capitalize on that opportunity to increase our weightage towards Japan equities. And if you compare it to say S&P 500 in terms of a discount, it is also it's also a lot cheaper than your S&P 500 index, your US equities, your Europe equities. So in terms of valuations, we think it's pretty compelling for us to start our toes into it at this point of time. So with the upgrade to Japan, we downgraded Latin America to neutral. One of the key problems with Brazil as well as Latin America is that of inflation. The inflation actually breached 10% in September, well above its expectations due to the combination of the rise in fuel prices as well as food prices. The ongoing kind of reopening of its economy could actually add further pressure to the kind of inflation dynamics that is seeing at this point of time, that which will actually exacerbate the kind of rate hike pressure for it to contain inflation. And part of the weakness within the Latin America region is that the Latin America central banks have been hiking interest rates. And as you hike interest rates, of course, equity markets will usually see a valuation downgrade. And that's what we are seeing at this point of time. Brazil central banks, in order to contain inflation, they've actually hiked interest rate by 5 times this year for a total of 4.25%. And they actually signaled another rate hike this month. Commodity price. So on one hand, they have this inflation going on for them. That is second. On the other hand, commodity prices, particularly when iron ore, which is one of the key exports for Brazil, has cooled significantly because of China's falling steel production, especially because of the falling production due to the energy rationing within China at this point of time. But on the positive end, the vaccination rate within Latin America, something that they have been struggling at the start of the year, has actually started to improve. So if you look in terms of in Brazil, there's more than 70% is already vaccinated with 1 dose, and more than 40% is already fully vaccinated. And for Mexico, they're slightly behind Brazil, but more than half of its population has already been at least vaccinated with 1 dose. So yes, things are kind of bad for Latin America at this point of time. But if you look at it actually it plays a very big part for the Latin America index with that of your commodity prices. So as your commodity prices comes down, Latin America index usually corrects. And this is partly due to China's steel production because of the energy rationing. But I think at this point of time, things are going to be quite weak. But we are actually expecting China to start picking back up, especially with the energy situation start to resolve itself. Steel production is going to be back again, given the fact that as well as your real estate developer space where things start to improve and start to recover, you're going to see a huge rebound within the Latin America index in response to that kind of thing. So all the negatives seems to have already been priced in. So it makes no sense to us to reduce our exposure by too much. So we actually downgraded Latin America only by 2.5% to neutral. So our last change was to add China financials into the supplementary portfolio. The China financial sector was hit with a sell-off due to the worries because of the possible contagion effect surrounding the Evergrande debt crisis. But at that point of time, when we were looking at it, we didn't thought that we actually kind of believe that China government will not let this situation go out of hand. In fact, if you look in terms of, and I think ever since a regulator implemented the 3-rate line, things actually started improving quite significantly for the real estate developers. But aside from that, even if the whole Evergrande were to collapse, the real estate were to collapse, the kind of material impact to the bank's P&L due to write-off in the real estate developer is actually quite limited. In fact, it's estimated that at least for the big 4 banks, the exposure of its books to the Chinese real estate developer is only about 7%. And so in PBs, PB multiple, the price to book ratio of China banks, because of the sell-off, actually fell to the kind of decade low levels after the months of pessimism surrounding China equities. So at this point of time, a lot of investors are just hands off Chinese equities right now, and that's also the reason why for the bad performance. In fact, they rotated within the EM space from China to India equities, which is also why India equities did pretty well for third quarter versus China equities. But at this point of time, we think we see value coming back. Valuations are cheap enough that the kind of downside has mostly been priced in already, and it's now sufficiently attractive in terms of a risk-reward prospect for us to add this back into our portfolios. So the other part is also, within China at this point of time, economic numbers are really quite weak. So if you look at the recent data points, the chart on the left, the City Economic Index, you can see that a lot of the nearest data points are actually underperformed or came below its expectations within China itself. And this is going to be a big ramification. This is going to have a big implication to the credit situation within China itself. Because as and when things start to be a bit weak for its economy, the China government will inject liquidity to kind of support a healthy level of growth for its economy. And when you look at the chart on the right, whenever they do that, when the credit impulse start to turn, so the blue line is actually reversed. So when it goes up, it means that the credit growth actually comes down. So what we are seeing is that credit growth has been dwindling for a while already, and it's starting to hit a bottom. And as it starts to hit a bottom, what it is that it will start to credit growth will start to grow again. And usually China financials, the banks, players in the banks, they actually will start to pick that up, and China banks will start to rebound quite strongly as we hit the kind of turning point. So at this point of time, we are starting to see the turning point, and we won't be surprised if we see a rally in the China financials within the next 2 to 3 months, given the kind of rebound within the China financials, as well as within the credit growth within China itself. So that brings me to the last part of this presentation, which is the kind of portfolio positioning we have at this point of time. So in terms of inter-asset allocation, we still maintain equity overweight over fixed income. Firstly, although equities have done a lot better than fixed income this year, we think that the yields offered by fixed income products is simply too low, and the kind of reopening gradual global growth environment is going to be quite supportive of growth within equity market. So yes, things are slightly of a roller coaster within the third quarter as we hit into the second in 2020, the next year. We think that equity market will still be able to kind of benefit from that kind of growth environment versus your fixed income market, which is kind of a little bit vulnerable to the rising yield environment. So on the intra-asset allocation, so what we did was we neutralized Japan as well as Latin America, leaving only our key underweights as well as overweight. So US we maintain at the underweight position, but a slight underweight given the fact that valuations have been so stretched for for US at this point of time. Asia, things are actually quite, I think, because of the recent sell-off, valuations are not as extreme as that of the US. So therefore, we are still very comfortable to hold an overweight position on it. And of course, alongside that of China, I think the weakness within China at this point of time is something that value investors or long-term investors should look to capitalize, especially if you look at our portfolio for something that you want to hold for 2 to 3 years ahead. You know that things will start to resolve for China at this given some time, and as a result, we look to our rebalancing or our overweight, what we are trying to do is we're trying to continue to maintain the overweight position for China at this point of time, to capitalize on the rebound within the equity market. And as and when after it rebounded, maybe then we'll look to reduce our exposure. But at this point of time, we are very comfortable in holding Asia as well as our China equities in terms of our overweight position. So if you look in terms of global equity markets, you can see that majority of the developed markets are now near its year-to-hit date high. So you look at US, is up about 23% on a year-to-date basis. Europe is up 22%. The top is at their year-to-date high. In fact, global equity markets as well. But if you look at China, you look at Asia, things are slightly weaker. Even Japan, things are not, even after its rebound, is still not at its extreme at this point of time. So if you look at it from a value point of view, it makes sense for us to look to maintain an overweight in Asia as well as China. So if you look at a PE valuation on a relative basis, you can see that the valuation versus the 5 years average is really extreme for US itself. It is near the kind of maximum PE that we have seen over the last 5 years, and that is quite consistent for developed market as well as the global equities, Europe as well. I think I'd like to draw attention towards Japan, where we see PE is at 16.3%, 16.3 times, where it's actually at its 5 years average. So things are actually quite reasonable for Japan at this point of time, which is also why we actually withdrew a bit of our pessimistic overtone that we have for the Japan equities at the start of the year. So I think that's the interesting part. The valuations is actually at its 5 years average versus the rest of the other equity markets, which is above their 5 years average, even that for China equities. But you can see that the difference between the two is the 12.02 is average of about 11.5. The kind of premium to its average is the smallest versus a majority of the global equity markets. So within bonds, at this point of time, yields are simply very, very low. Majority of the segments are now trading at record lows. We see US Treasury bond yields at around 1.1%, US corporate IG bond yields at around 2.24%. Even US corporate high yield is at 4.22%, which is near the 5 years low. So the only kind of standout performer at this point of time, the kind of standout in terms of yields, in terms of attractiveness of yields, is of course the Asian high yield market at 11.5%, and it's actually near its 5 years high, and which is also why we are comfortable in holding an overweight position in Asian high yield at this point of time. If you were to look to invest into the market, you will know that it is actually a good opportunity. It's a good time for you to capitalize on the weakness within the Asian high yield, to capitalize on the high returns that is. And if you look in terms of a historical basis, you know that it doesn't stay at 11.5% for long. Eventually, as things start to stabilize, it will kind of retrace back to its average level of around 7 to 8%. So at this point of time, we think that if you were to look in, that's why when we rebalance our portfolios, we maintain to have Asian high yield at overweight position to capitalize on the kind of appealing returns for this segment. Something that we are watching at this point of time is really the higher interest rate environment. Actually, this is a slide that I've shared in our last quarterly update, as well as the start of the year. We saw that inflation expectations are starting to pick up. I think investors have been kind of pricing longer inflation risk a bit lower than was implied in the inflation break-evens as well as. So overall, the chart on the right is trying to show is that the interest rate expectations were actually quite low. And this is something that we have pointed out. And of course, after Fed has announced that they are looking to taper, we start to see the inflation expectations starting to pick up quite strongly. And also, of course, with the latest September inflation print, where the inflation was up 5.5%, 5.5 or 5.4% again, which also means that inflation may not be as transitory as what people expected it to be. So, but at this point of time, we think that investors are still kind of underestimating inflation risk at this point of time. And when inflation were to start to pick up, or investors to start to demand for higher inflation compensation, that will actually push US Treasury yields higher. And what we have seen is that as US Treasury yields pick up, US Treasury yields is sort of seen as a discount rate or risk-free rate for global equities. And whenever your risk-free rates start to pick up, your valuations will compress, will be downgraded, because you now demand you need to demand a higher less of a premium from because of a higher premium because of the rising risk-free rates and discount rates. Cost of borrowing will go up. A lot of your leverage activities that being run within the US within the equity market at this point of time will become a lot more costly. And overall, we're going to see global equities starting to come back down, which is also why I think valuations will become a very key part of investing forward into the rest of the year as well as 2022. So with that being said, there are two segments that we are looking at to potentially add on in our exposure. So one is Asian high yield, where we actually see higher risk, but it comes with higher returns. So our investment thesis for Asian high yield bonds actually remains quite intact. It offers the higher yields in the bond market at this point of time. It has attractive valuation both historically and relative to peers. It's actually because of its low duration, about 2.9%. It's also a lot more resilient to any interest rate changes. So we expect that the expected default rates to start picking up. As a lot of the smaller real estate developers start to default. We saw that within recently with Fantasia, even though they have the ability to pay out as these companies, these real estate developers start winding up, we will see default rates picking up. But the yields offered at this point of time by the Asian high yield market is picking up as well, which means that your risk seekers who are willing to stomach the kind of volatility is actually well being compensated with the largest risk premium. So Asian high yield is now offering at a yield of 11%. So while default risk can rise, current valuations are near the top, the maximum, or near the highest in terms of its yields. So we think that in a way, there's a certain form of safety in the fact that a lot of negative are already being priced in for this particular segment. So if you look at it in terms of relative to other high yield markets, so your global high yields, your US high yields, the kind of credit spread of Asian high yield is a lot more compelling compared to those different segments. On a historical basis, you look at the credit spreads, is also above the kind of 2 standard deviation that we have come to expect of the Asian high yield market. And you can see from the chart on the right, the kind of credit spreads don't actually stay for very long above its 2 standard deviation level. So at this point of time, we look at, yes, things are, you're going to see a lot of negative news forward for China real estate developer, at least for the next few months or so. But we think that a lot of the negative are already being priced in, and valuation shows that it's already being priced in, and there's not actually much to worry about, given the fact that we are actually quite well compensated for. So if you look at China's real estate developer in terms of the fundamental end, they actually made quite massive improvement in terms of a 3 red line matrix. So we are seeing that fewer listed China developer actually breaching the kind of regulatory limits over time. So while Evergrande can default, we believe that China authorities will take steps to prevent the debt crisis from destabilizing. But at this point of time, Evergrande shows that they are trying their best to make payments to make good of their debt, and we are starting to see the situation starting to stabilize, which is also means that we can expect that us to be well compensated for our overweight position within Asian high yield at this point of time. So investors, and the good thing is that we get exposure to the Asian high yield market via a fund, which is essentially a basket of issuers across a geographical region as well as sector within the Asian high yield market. Although, of course, a huge part of it unavoidably will be the China real estate developer. But the good part is we get to, we are not exposed to a single name. It's quite well diversified within the segment itself. So for the other segment that we are looking at, maybe in our next rebalancing to add into our portfolios is onshore equities, A-shares equities. We see that A-shares equities being kind of the poster child to benefit from the common prosperity push. So for us who are looking, especially a lot of our investors who are looking a bit tired of the kind of prolonged regulatory crackdown within real estate and technology, can of course look at the domestic A-shares market that has been actually starting to develop away from its old economy kind of exposure. So previously, a lot of them were kind of dominated by financials. Financials plays a very big part. A lot of the consumer staples were a very big part of it. It's still so, but it's starting to change already. In fact, I think we think that we are seeing that the Asian market is starting to adapt to the growth trends or to the kind of common prosperity trends. So particularly so it's actually well positioned for the kind of common prosperity push, and at the same time, it's not vulnerable to the kind of sectors that are vulnerable to your regulatory crackdown. So your Tencent, Alibaba is a lot smaller in terms of weightage versus your offshore hit shares. And in terms of long-term prospects, things are changing. So weightage of technology stocks, which is something that has always been very, very low within the A-shares market, is starting to increase. And I think this is a very interesting development. When it comes to tech exposure, we always look at hit shares. We always look at offshore tech exposure for a lot of your household internet names like Tencent and Alibaba, which is kind of in the crosshair of Chinese regulators. You look at tech names within China A-shares, they are actually mainly a lot of your tech manufacturing. So your critical technology that China looks or are looking to develop. So your semiconductors, your 5G infrastructures, as well as a lot of your green initiatives like your solar panels, your electric vehicles. These are things that China look to develop for the next 5 to 10 years. And it's on their 5 years plan. It has been mentioned a lot of time by President Xi as being on their top of mind. So these are segments that can benefit from the regulatory support. And because of that, we will see that the kind of supportive tailwinds will actually boost China A-shares ahead. So this is actually a partful for our China exposure. This is something that we are looking at into maybe to change our exposure towards our onshore equity exposure, or to include or increase a bit of China A-shares equities as we go on heading into the rest of the year. So with that, I've come to the end of my presentation. I'd like to really thank you guys for staying all the way to the end. It's really lengthy presentation, and I really appreciate the fact that you guys stayed all the way through. And in fact, not just presentation, but from the portfolios, from the kind of AUMs that we have, what I'm seeing is that our AUM has been really resilient, and investors have been adding in over the last few months, despite the kind of sell-off within China, the kind of volatility within the market. I think a lot of our MAPS investors continue to be faithful to us, continue to have confidence in us. And I think it's not easy, particularly because of a lot of negative news development. And I really like to thank you guys for the kind of ongoing support. And we hope to, as things start to stabilize within Asia itself, our overweight position to start to earn themselves in terms of returns. And I'll be psyched to in the next few months possibly announcing that because of our overweight position, our portfolio start to outperform the benchmark. So that will be something that we hope that we will be able to see for ourselves. But yeah, so till the next time, the next quarterly update, do stay safe, and thank you so much for attending this webinar today. Thank you.